Please mute yourself so that we have, please mute yourself so that we can have one audience. Okay, so as you are joining, please mute yourself, unmute yourself when you want to ask question. Okay, so that we don't have background sound coming in and disrupting what we're doing. Okay, so please, as you're joining, mute yourself, and we'll start. Okay, I believe you people are seeing the screen. If you are seeing the screen, just give me a thumbs up or something. Okay. If you are seeing the screen, just give me a thumbs up or a reactions. And if you can hear me as well, if you can hear me, and also if you can see the screen, give me a thumbs up so that we start. Okay. Give me a thumbs up if you can hear me, and as well if you can see the screen. So we're good to go. We're going to be talking about a lot, okay? But we're going to look at taking for ground, like someone that doesn't know anything about Forex market. So it's going to describe the basic class. So we're starting from introduction of Forex. From there, we'll move to the business, creating a niche for Forex as a business. You know, there's a way most traders trade the Forex market, and they don't trade it with record and with perspective of looking at it as a business. Okay. And you know, when we talk about business, we have sales, we have income, we have expenditure, and all of that. So that's what we're going to be looking at, having a niche in the financial market and looking at it as a business. So we're also going to be looking at the different markets, different market opens. Okay, and we look at basic. Mute yourself as you are joining the class. Please mute yourself so that we don't have a background noise. Mute yourself and be disciplined enough to not write something on the screen. I'm seeing some stuff on the screen. Okay, so we'll be looking at currency. We'll be looking at currency rates, and we'll be looking at currency exchange rates. Let me just be just giving us a preview of what we're going to be discussing. We're going to be discussing what is Forex, what Forex is all about. This. If you are joining, please mute yourself. How can I mute everybody?
अभी कुछ बैंक में आपका कुछ कागज को वगैरह लोचा होगा.
Please not mute. This is here. Yes. Okay, so please mute yourself as you're joining. So we're going to be looking at the business of Forex trading, and also slide 4, we're going to be looking at Forex time, and we'll also look at the basic Forex basic, that's the terminology, and the currency pairs. We'll look at currency exchange rates. We'll also look at contract lot size. We'll look at calculating Forex profits. Okay, so we're going to be looking at standard lot size. Okay, and we'll look at how to enter, where to enter, and how to enter. Okay, then we'll look at profits. Sorry if okay, thank you very much. So we'll also look at profit by going short. We'll be looking at how to profit from Forex moves. Okay, so, and we discuss a little bit about the power of leverage, and we'll move to having trading edge in the financial markets. Okay, that means using statistical edge. And we'll also be looking at the 4 kinds of traders: the swing trader, the scalpers, the position traders, the day trader. Okay, and we'll be looking at how to use MetaTrader 4. We'll go live this time. We'll go live on how to use MetaTrader 4 or MetaTrader 5. And we'll be looking at the types of market analysis, okay, technical, fundamental, and market sentiments. And we will now put you through into the professional form, okay? So if you want to get the details in professional, we go deeper, but we won't be doing that today, okay? Because Forex trading is wide. We won't be doing all this position sizing, impulse pullback, psychology of trading. So these are when you come for the professional course, we get this professional FX trading curriculum. We'll look at that, and probably we'll stop there. Then we can go into maybe financial freedom, but that's another topic for the day. So these are what we're going to go through. So we are starting the class now. If you have any of your friends that need to be here, just send the link. So, okay, so put on your seat belts. If you have a write-up, you can get your a write-up materials ready so that we start. Okay, so I'll be starting now. Let me go to slideshow. Okay. So that we get a wider screen. Okay. Okay, so good evening or good afternoon or good morning from anywhere you are joining the class from. Okay. Forex Champions Academy. This is part of our academic course, and we're going to be looking at Forex from the beginning, from the start. So what is Forex? Okay, Forex is a foreign exchange market, which is Forex. It stands for the FOR is the acronym word. FOR is foreign, and the EX is exchange. Okay, so it is foreign exchange. When you hear Forex, it means foreign exchange. And what is foreign exchange? We'll be thinking foreign exchange is okay, so the foreign exchange Forex market is one of which a nation currency is traded for that of another at a mutual agreed rate. So we are talking about buying and selling of currency. It's a simultaneous buying and selling of currency. So the currency of another country is exchanged for another one. Okay, so we are talking about exchange here. Okay, so Forex is simultaneous buying and selling. Is a simultaneous buying and selling of foreign currencies. Okay, so currencies are traded in pairs. So we're going to be looking at that. Currencies are traded in pairs, and Forex market is run electronically with a 24 with a network of banks. Okay, Forex is run 24 hours. There are some markets which run more than 5 days, like the index markets run for 24 hours and 7 days in a week. But the main currency markets is 24-hour, 5 days in a week. That's from Monday, Tuesday till Friday night. Okay, so that's one thing about Forex. Then we'll be looking at is the what's the characteristics of it? It's the largest market in the world, traded with 3.6 is more than this $3 trillion per day. And if you compare that to that of stock, which is 500 billion for stocks, you can see that Forex is bigger. Now it's currently around 6.something trillion per day. This is a market that traded $6.5 trillion per day. This was not updated. Excuse me a little bit. Let me post something on my page so that people can join, because we expect more people to join. So let's get to remind those who are yet to join. Okay. So let me just post this thing, they will continue. Okay, so please mute yourself so that we don't get distracted as you're coming in mute, so that we don't get distracted. Okay, so it's the largest market in the world, is traded with $6.5 trillion per day. And if you compare that, and it's meant to grow. Okay, it's meant to go. It started with 3.6 trillion, but currently, if you check for the volume of Forex market now, it's close to $6.5 trillion. So it's the largest market in the world. So there are lots of opportunity there. Is big, is huge compared to any stock market of any country at all. Even the US stock market. US stock market is trading currently around, is still in billions. Okay, but Forex is the largest. If you compare that to even crypto market is around 2 trillion. Okay, but Forex market is $6.5 trillion per day. That's the volume of money that is being traded in this market. So you can see how huge the market is. Now, because the market is very big, you can decide to do anything in the market. You can decide to trade with different strategy. But my focus, or the focus of this class, is to build your mindset of trading Forex as a business. Okay, carving a niche in it as a business. So you know what a businessman would do if you want to do any business at all. You want to know the risks of the business, the opportunity thereof, and the environment and all this. So that is the main view of this market, this class, which is the basic of Forex. So the business of Forex trading. What is the business of Forex trading? We'll be looking at now what entails Forex to be a business. Minimal investments. Okay, with Forex, you can start with as little as $200 or $100. On broker, you allow $50 or $20 or $10. So if you want to start any business at all, you have to bring, you need to, if you want to, even if it's a restaurant business, you need a bigger amount of money, more than $200 or $50, depending on the environment. Forex allows you to start this business with a minimal capital. Okay, so a minimal capital of 200. We have different type of accounts in Forex. Although we have accounts that is micro account, we have mini accounts, we have standard accounts. So, but a mini account of $200 with your small lot size, you can start the business of Forex with $200. Okay, then minimal time commitment. So you don't have to spend the whole time. You can be working, okay, or be doing other things and also be a trader or do your trading as a Forex trader. So you can commit some part of your time, okay? It's all around market, but there are certain times that market moves. So you can decide to trade in such time. The market session are of different type. We'll go into that. So you can decide to choose a market. If you have time in the night, you can decide to choose night trading. If you have time in the morning, you can decide to choose in the morning trading. If you have time in the afternoon, you decide to choose afternoon trading. So you have a privilege of use of less time commitment. Okay, so you can decide to commit 3 to 6 hours a day. Okay, is more than sufficient enough for you to be a trader, to do the Forex trading business. Okay, 3 to 6 hours. Maybe do your analysis, watch the market. Within 3 to 6 hours, you can program your trading platform and go and do any other things that you want to do. So these are advantage of being a Forex trader or doing the business of Forex trading. Also look at recession proof. Forex trading is recession proof. Recently we look at people going through retrenchments because of coronavirus. People are set off of their work. They can't go back to their work. Economy meltdown, and it's affecting a lot of businesses. But Forex market, the recessions or crises does not really affect the markets. Okay, so if you position yourself, you can even take advantage of any form of crisis that is going on, because those crises affect the currency movements, and you can position yourself to be on the advantage side. So it is recession proof. That does not mean because there are some people, when they are into a business, when recession it affects the business, it keep them out of the business. But Forex trading, you can stay in the business, okay, because it's recession proof. Now, to succeed in forex trading, you need to work hard and also work smart. Okay, you must be willing to work hard and master this profession. Professional skill is a professional skill, is a skill. So it is better, is a good skill or a better skill compared to other skills or other professions like engineering, doctor, accountant, any other field at all. Why is it that? It's because this is a skill that you learned. Okay, when you have the skill, you own the skill, it is your skill. Okay, you can decide to pass this knowledge to someone else, to a younger person, to your child, to anybody. Okay, but the skill is in you. So you can trade at 90, at any age. Okay, compared to all this profession that if you get to a certain age, you'll be asked to maybe step down or through retrenchment, or something can happen to a company. They can ask you to lay back. And for example, also probably you are a professional engineer or a doctor, and you are working in an organization. If you decide to call for a salary raise, your employer can decide to say, wow, you are asking too much, and put you aside. Sorry for the break. I think the network is shaking, so let's share back again. Okay, so that is one of the advantage of being a trader or coming into the business of trading, because it is your business. You decide what you want, and you cannot, once you have the skill, you can trade anytime, anywhere, from anywhere at all. Okay, so it is very, very advantageous to create a niche or a business model as a forex trader. So the business of trading, or the business of forex trading, so it's a 24 hours market. We've discussed it. It's give you flexibility. You build your business from anywhere around the world. You plan your daily routine or activities around your trading, and as well, you can also, that does not mean you should leave your job. You can do your job and also be a trader. So you generate consistent profits of 5 to 20% a month are very, very possible if you key into the structure of forex business. Okay, so if you understand the knowledge very well, use your money management and everything, there's a possibility of making 5 to 20% of your accounts monthly. Okay, there are traders who make more than that even a day, but the risk is vast. But if you don't want to risk much, you know what you are doing, you can decide to put it low at 5 to 20%, and that's what we're going to be discussing on this course. So for example, let's say you have $100,000 account, and that's 5% of that account in a month is $5,000. So there are people who can live with 5,000 and they can live well. Okay, and if it is 20%, you're able to make, that's 20,000 a month. Okay, so you can see the opportunity of being a trader. Time and trading session. So these are time session for the market. I break sorry that for those who are this is a time session. I just converted it to African time. Okay, so you can check out for time and session around your country there. Okay, but this is African time. So let's say we have a 4 market session. Actually, 4 major. We have other ones, but we have 4 major market session, which have the Sydney market session. The Sydney market session opened by 11, okay, and closes by 7 a.m. Okay, this is plus 2 GMT, okay, and it's Tokyo session opened by 1 a.m. and closes by 10 a.m. So London session opened by 9 a.m. and closes by 5 p.m. New York session opens by 1 p.m. and closes by 10 p.m. So you can decide to choose any of this market session that suits your timing or suits your availability of time to trade the market. Okay, most time the market is more volatile or have more liquidity when 2 market session lapses. Okay, so you can decide to start trading if you are from this part of the world and you want to start trading during the afternoon session. You can decide to start trading from 1 p.m. to 5 p.m. Okay, that's when the London session and New York session open simultaneously. If you're a night person and you can only have time in the night to trade, you can decide to start trading from 11 p.m. to probably 1 a.m. or 10 a.m. depending on what time you have. So you can decide to create those time at that time to trade. Okay, so we'll look at the basic Forex is quoted in currency pair. Okay, Forex is quoted in currency pair. So when we said it is simultaneous buying and selling of currency, simultaneous buying and selling, that means if you want to buy a currency, you must as well sell the other currency. So it is pair. You cannot just say, I want to buy US dollars. You in currency, in Forex market, you must say, I want to buy US dollar versus Euro, or US dollar versus Great Britain, or Great Britain dollar versus Australian dollars. So they are quoted in pairs, and it is being represented with 3 letter words. So these are 8 common currency symbols. Okay, the common currency symbols are here. From the chart, you can see from number 1, we have Euro, which is EUR. Okay, EUR stands for Euro, USD stands for US dollar, GBP stands for Great Britain pounds, JPY stands for Japanese yen, and CHF Swiss stand for Swiss francs, AUD stand for Australian dollar, K or Canadian dollars, and NZD stand for New Zealand dollars. And we have other currencies like this ZE, which is sorry. Okay, so as they are being paired, we have them as pair, as you can see. Okay, successful trader only trade the most common and liquid 7 pairs, which is Euro USD. This is a pair. So if you want to trade this, you want to trade Euro, you must trade it with a USD. That means this is a pair, is a single trading instrument. So if you buy this, it means you are buying Euro and at the same time you are selling USD. Okay, and if you pick one of these, which is Great Britain USD, it means that if you want to buy, you are buying Great Britain and you are selling USD. If you sell, it means you are selling Great Britain and you are buying USD. So it's a simultaneous process. So these are the pair. You treat them as one, but simultaneous buying and selling. If you are selling one, you are buying one. Okay, so we go quickly to currency exchange rates. Okay, currencies are quoted in pairs, as I said, and we have mostly in 4 decimal places. Now, this is how the numbers arrange in currency. We have Euro stroke US, that is Euro USD. Now, if you go to the market or you go to the chart you want to trade, you see Euro USD is equals to 1.35052. This is an example. Probably currently it's 1.1 something. Okay, so now what does this number stand for? This one, the first currency, which is EUR, is called base currency, while the second currency is called the coach currency, that's the counter currency. Okay, then we have the numbers like representing one trading instrument, 1.3505. So now this means that as a trader, you are looking at the numbers. Okay, so the number, they normally 4 decimal place, but there are some which are 5 decimal place. So now the last number, which was supposed to start for the 4 decimal place, is called pips. Okay, we call it this, it's a pips. And the smallest one, or the fixed number of fixed decimal, is called fractional pips. Okay, so you don't focus on this fractional pips much, you focus on this. So this is where the change occurs. Okay, so you are buying when you feel the price is going to go up. So if this increase to 10 or increase to 6, it means it will go up. Okay, it means it has increased. If you reduce by 5, it means it has reduced. Okay, so the pips is where you do most of your calculation as a trader. The pips is where you calculate how much you're making in the market, how much you want to make, and all of that. So we are looking at the base currency always has a value of 1. Okay, so this base currency has the value of 1, and the other one is this the other number is this. What it means is that it takes you 1 euro to have 1.350 USD. Okay, so that's what it means. So it takes 1 euro. So always the base currency is 1. In this case, 1 euro is equivalent to 1.3505 US dollar at that point in time. So it changes, it increase or reduce. So at that point in time, that's what it is. Now, if you want to buy, let's say you want to buy, if you want to buy 1 euro, you would have to pay 1.3505 US dollar. Okay, so if you go to an exchanger or a bank and you want to buy 1 euro and you come with $, they will say you should bring $1.3505. That's the business you do. But in this one, interbank trading as the Forex market, it is being programmed. So this is just to give you the basic knowledge of what is happening in the computer system. Okay, so if you who's doing this? Sorry, who is putting arrows on this screen? Okay, so if you want to, okay, if you want to sell 1 euro, you would receive. So if you have 1 euro in this example now, you're going to receive 1.3505 US dollars. Okay, so that's what it means. Okay, so let's move to the next one. So currency exchange rate, while all other pairs are quoted in 4 decimal place, which is 1 pip is equals to 0.001. So this is 1 pip. The last number there, the fourth number is okay. Then the JPY pairs are quoted to 2 decimal place. So just JPY is Japanese yen. It's a different currency pair entirely. So its quotation is different. So we're going to be looking at the difference between the quotation and normal currency pair. So look at now, this USD. This is a pair that has JPY. So normally we're going to see it as this. So 98.73. So this one, the fourth number there is the while the while the last number, the small number, or the fifth number, the fractional pips. Okay, so this is how this is quoted, where any currency that has JPY is mostly quoted like this. Okay. So as you are joining the class, mute yourself so that you don't get distracted. I need to mute this, I guess. This please mute yourself. Who is there? Who is that one talking? You should mute. Okay, so this code tells is what at $1 US dollar is equivalent to 98.73 Japanese yen. Okay, so pips is price. What is the meaning of pips? You might ask, what is the meaning of pips? Pips stand for price index points. Okay, pips stand for price index points. And pips is the smallest change in value for any given forex quotes. Okay, so for a non-JPY forex pair, 1 pip represents the 4th decimal place of the quotes. Example, we have the Euro USD, which is from 1.3505 to 1.3506, means there is an increase of 1. Okay, so it is a movement of 0.001 or 1 pips. Okay, now for a JPY forex pair, 1 pips represents the second decimal place of the quotes. That is each point. Example, when USD JPY moved from 80.55 to 80.87, it is a movement of 32 pips. Are we there? Because the difference between this and this will give us 32 pips. Okay, so these two, if you need to understand what pips means so that you can get your calculation right, because that's where you can make money, or that's where you can know which of the risks you're going to risk. Okay. So we have what we call contract size. Okay. And contract size means one standard lot. There's what we call lot size. You'll be asking, hearing the word lot size. What lot size do you use? A standard lot size is a contract lot size, which is of 100,000 base currency. Okay, so if you use a standard lot size, it means you are purchasing 100,000. You are purchasing 100,000 base currency. Remember, we say a base currency is always one. Okay, compared to the counter currency. Now, this is what we mean. We have the currency pair Euro USD, USD CHF, Great Britain USD, USD JPY, Great Britain pounds JPY, Australia US. This is the standard lot size. Okay, one standard lot size on this contract means that it is 100,000, and 1 pips of it is 0.01. 0.000, and that's the change, okay, the smallest change. And then we also look at USD CHF. It means that it is 100. If you buy or sell, you are buying or selling on a standard lot size, you are buying or selling 100,000 base currency, which the change can be 0.0001. That's the smallest. And then Great Britain USD, if you buy or sell, it means you are buying or selling the base currency of 100. If you use one standard lot size, it means it is 100,000 contracts, okay, which is 100,000, and the change can be 0.0001. That's the minimal change. Okay, the same thing go for all this. Okay, now if you look at the difference of the pair that has JPY, you can see that the change is 0.01, not 0.001. Okay, that's just the difference. So any pair that has JPY, the pips is in this form. While other pairs that does not have a JPY, the pips change is 0. This is the smallest change, okay? And we're going to be looking at standard contract. A standard lot is 100 units of the base currency. Example, when you buy one standard lot of Euro USD, you are buying 100 euros with a US dollars. You are buying 100. So, remember I said we have different types of accounts. We have with their different lot size. So we have, if it is standard accounts, any unit you buy there on a standard account with a standard lot size of 1, it means you are buying 100,000 contracts. Okay, while in a mini account, any lot size you use, a minimum lot size you can use of 1 is 10,000 units or 10,000 contracts. When we have a micro account, okay, so which if you use a 1 lot size, it means that you are purchasing 1,000 units or 1,000 contracts. If you are using a nano account, which those are accounts that you can fund with $10 or $5 or whatever dollars, it means that you are buying 100 contracts with a 1 lot size. Okay, so you need to understand this so that you know what lot size you're going to use, the money management, when to your number, what to calculate. It's very simple when we go to the practical session. Okay, so just keep in mind, if you're not getting it, just follow through. Okay, now these are now we are moving into calculations, because I remember I said it's a business, so you need to get your calculation right when it comes to business. Don't just do any business without forecasting, without knowing your numbers. Okay, so most of this session is we're going to be doing calculation and numbers. Then we'll go to how to trade. Okay, so it's more of professional course on trading as a business. Okay, so the first thing they're going to be looking at is profit stroke lost. Okay, so we'll also be looking at the number of pips, and we'll also look at the number of lot size, And we also look at the value per pips per standard lot size. So your profit or loss is equals to the number of pips that change. That means the number of pips that you gain or you lose times the number of lot size you use, the contra lot size you use. If you use 2 contra lot size on a standard account, it means you are purchasing 200,000 loss, 200,000 contract. If you use 1, it means you are purchasing 100. So we're going to be then the value. This is value per pips. Okay, you can decide to make any of those pips any value, whether you may want to make it $10 or $5 or $2 or 10 cents. Okay, so dollar per standard lot size, but this one is standard. It means that it has a standard value. So dollar value per pips per standard lot size is normally 10. Okay, it's $10 or about $10 depending on the pairs you are talking about. So a standard lot size has a dollar or has a value dollar of 10. Okay, for most of the actively traded pairs, which is actively traded pairs, which is, for example, Euro USD, Great Britain USD, Australian USD, a standard lot size value is $10. We have some that are $8 or $9.5, but this is for this. So if you want to know more about it, you can go to this website to know is your lot size, the value of the standard lot size you are using. You can go to this website, https://www.mtpredictor.com/pips/value-table. You will see the value of each standard lot size for each pairs you want to trade. So find out the value per pips per lot size of all major currency pairs. So that you know what you are doing, you know you get your numbers right. Okay, then this is the table. If you go to the website, okay, this is the table. Go to the website. When you go to the website, this is we're looking at. Okay, so when you get to the website, you see those standard, you see the table there, and you can use it. So let's now go to profit. How do you trade? Okay, I don't know, maybe I can take some questions from the calculation before we move into the technical part, trading, and also moving. So do you have any questions? I think we started 15. Okay, we spent close to almost 30 minutes. So do we have any questions so far, so that I can take the question sharply, then we'll move to the next session, which will be looking at the buying and selling, okay, where to buy, where to sell, and also put the calculation in place. If you have questions, just signify. Let me stop the sharing. Sorry. Okay, so I think some people very clear. Okay. Do you have any question? You can drop your question also. I'll wait it from here if you have any question. So what's your question? Somebody is asking question. Okay, somebody said there was no question. Okay, so no questions, that means we'll go ahead. If you have a question, you can ask later. So if you don't have any questions, let's move on to the next session. Okay, I think I am. Okay, so we are looking at some terms in Forex. When we say go long, long means you should buy. Okay, when we say short, it means you sell. So from this chart now, you can see that profit by going long. That means profit by buying. Okay, so we have 3 types of analysis. We're going to be looking at those analyses: the technical analysis, the fundamental analysis, the trader sentiment. Okay, so when you get your charts, this is a chart for Euro USD, for example. This is a chart for Euro USD. And let's say you want to trade Euro USD, you want to trade it, whether you want to buy or sell. So for this example now, you are buying. So, and you want to buy one contract, that is you want to use a standard lot size. You want to buy one contract, which is 100,000 USD. Now you look at you will do technical analysis. You will see from here that from the chart, now these are candlesticks. We call these candlesticks, okay? They represent price, okay, in a psychological level. So this level is a psychological level. We call it resistance or support, depending on where the price is. But currently, the price is above it around this place. So this place is a support level. So market is touching the support level. It has a chance of going to the next level, which is the resistance level. So from this point, if you understand the market very well, you understand your analysis very well, what do? You buy, okay, at this point, and you target this place. Okay, so you buy here and take, so for example, you are buying at buy Euro USD at 1.13510. Okay, so you are buying at this price currently now. So if you buy at this price, because this place become your resistance, you will move to this place. Okay, and quit the trade in this resistance level. So we have buy at this point, okay, and then you sell here, okay. So look at it now. So your entry is here, your exit is here. So in business, you must know your exits and you must know your entry and know your exit. So those are the technical part of the trading. So we're using this to illustrate to you. So if you buy here 1.13510, okay, you buy Euro USD, and it gets to this point. So this like is your parameter. There's a parameter you're going to set to know that this is a point you're going to exit the market. You're going to cash out your profit because you have already, there's a change, increase in pips. If you look at the number very well. So from this to this, we have 1.14350. And here we have 1.350. So if you calculate very well, there's a change in pips close to almost 100 and something pips. Okay, so we're going to look at the calculation now. So if you look at this, is a profit. You made profit of, is it it should be I don't think okay, so if you calculate the difference between this, I think it should be 84. Let's say it's 84. Okay, so that means there's an 84 pips gain. So these are now, you now calculate your profits. That means the pips gain times the standard, because we are using a standard contract, standard loss size, which we said our standard loss size is $10. The value for the standard loss is $10. Okay, times one standard loss size is going to give us $840. Okay, so that's the profit you make now because of this change, because you use a standard loss size, which a standard loss size value is $10 per pips. So each pips you move is $10. So that's why you gain 84 pips. So 84 times 10 will give us 840 pips. This is your profit because you enter at this price and you quit at this price. Now this is a profit. So this can be calculated for you automatically by the system. You will see the profit there. But you are the one to determine the loss size you're going to use, okay? While the change in pips depends on the market, okay? So the market, you just to project that the market is going to move from this point to this point. So you project, and actually it did. When we enter at this price, it moved up. We enter at this price and the thing moved up to this price and we quit. So at the point of quitting at this price of 1.14350, we make a gain of 84 pips. So now we want to convert the 84 pips to dollar value. You multiply it by 10 because we are using a standard loss size. Okay, so you can decide to use $5 as your loss size. You can decide to use 10 cents. You can decide to use, depending on the risk management, which we are going to be discussing. Okay, so let's move on to the example for a sell. That's a short. Sorry. This for a buy. Okay, so this how to profit from move. This is just another example. I don't know, maybe I should just use it to explain again so that we get what we mean. Okay, this is what we mean. We said if you go long, which means you buy one standard contract of Euro USD at 1.13510. Okay, that means you buy this, you buy at this, then you sell at this. So the difference between this and this is 840 PV. Supposed to be 8 because of the last number there, it is 84. So the profit is equal to the number of pips times the value per pips and standard lot size of the lot size. So this is how it is on the tabulated form. So you use 100 contracts and you purchase, then you sell at this price because you multiply this price, okay, this price that you put, which is this, okay, by 1,000, you get this. Okay, so if you add this up, it's going to be 0. You add this up, you're going to get plus 84, which is the 84 piece. That's how we get 84. This is a background calculation, but a very simple calculation is you move from 1.13510 to 1.143. So you calculate the difference, that's the pips gain because you buy. Okay, so let's just leave that at that. And let's just leave this a percentage. Okay. Now, for example of that of a sell, okay, if you open your chart and you sell, probably this is where we bought, you know, you're now selling because you feel the market has gone up, it's going to come down. Okay, your work as a trader is to buy low and sell high. So when the price go high from your chart, you sell at a higher point. When the price is low, you buy. Okay. So for example, now this second example, going short. Remember, I say short is sell. Okay, while long is buy. So you're going short. When you say short this particular product, they are telling you to sell. Is a market, is a market language. Okay. So you sell at this point, okay, from your chart, which is 1.14289, okay, and then the price dropped, okay, because of your analysis, and it dropped to this point. So as it dropped to this point, you know, this is support level, you have to cash out because it might go up again. So you close your trade at 1.13510, okay, you close your trade at 1.13510. And the difference between this and this will give us almost 77 pips. So if you use the formula of calculation, you are going to get $770 for your profit gain. Okay, because you used a one standard lot size, a very big standard lot size though. So this is just for example, and this is how it is on a contract base. Okay. Difference between Euro USD buy or sell at 1.14289 to 1.13510 is going to give us 77 pips. And if you multiply the 77 pips times the dollar value of a standard lot size, which is 10, you're going to get $770 profit gain because the price dropped. Okay, so this is how the workout look like if you look at the calculation. Okay, and this is possible because of leverage. Okay, without leverage, you will need this big amount of money to make this profit, which if you look at it, the profit change is just 0.29 return. So you might say, I put in $140 something and I'm getting this small money is big. So as a trader, you are not bringing the 100,000 that we are talking about. Okay, there's what we call leverage. Your broker will allow you to use a small amount of money to leverage. So we have a leverage of almost 1 to 100. Okay, so if you use a leverage of 1 to 100, it means that for each dollar you deposit into your accounts, your broker will give you $100. So if you deposit $100, your broker is going to give you $100,000. Okay, as the equity to be able to trade. Okay, so because of that big amount of money, you can leverage on the small movements in the market. Okay, Forex market does not move hugely because people will say, you are telling us we can make 10%, or some people are making 100% in a day. How come the Forex market does not move up to 100%? The movement, the changes is around maybe 0.2% or 0.3% volatility of the market. It's only cryptocurrencies, okay, like Bitcoin and Ethereum and all of those that move very, very high. Okay, they move almost 5% or 2% in a day. But when it comes to currency market does not move much. But because of what we call leverage, where your broker account allows you to use leverage with your small accounts, with your small amount of money, if you put 100,000 and you are using a leverage 1-to-1, you can use more than that amount of money to trade. So you can decide to use a small leverage or use a big leverage, okay? So the power of leverage, this is the power of leverage. Okay, in Forex, brokers allow traders to leverage up to 1 to 100. Okay, this means you can buy or sell 100 contracts, we said, with just $1,000 margin. So if you bring $1,000 in your account, you can trade this amount of money. You can trade 100,000 with your $1,000. Okay, it is called leverage. Okay, so you can be able to execute use a standard lot size, as you said, to execute 100 contracts. Okay, so now, for example, if you are using a leverage of 1, you can decide to choose the leverage. Okay, there are some brokers who even allow you to use leverage 1 to, if the higher the leverage, the higher the amount, the contract value you can buy. Okay, some brokers allow you to even use leverage 1 to 1,000 or 1 to 800. Okay, so but as more as you use a bigger leverage, it increases your risk exposure also. So most people are very, very skeptical about using leverage, use a lower leverage. So if you use a leverage of 1 to 10, it means you just need a margin of 10%. If you use a leverage of 1 to 200, you need a margin of 5%. If you use a leverage of 1 to 50, you need a margin of 2%. If you use a leverage of 1 to 100, you need a margin of 1%. Okay, so that's how leverage work in the financial markets. Okay, so in most trading situations, we usually only leverage 1 to 20 for those who are you want to be, but I recommend you should not go beyond 100, 1 to 100. Okay, there's broker would even just set you to use 1 to 500. Okay, but even if you have that, you should not be taking multiple trades. You just allow it to take multiple trades. So if you are using small leverage, it disciplines your account not to take more than what your account can take. But if you are using a bigger leverage, you can put so many positions. Okay, and with that, if you get a right direction, you can make more money. But if you get a wrong direction, it will wipe you out easily. So for you to be more conservative, you use a lower leverage like 1 to 20 or maximum 1 to 100. Okay, with a, like, let's say people use leverage of 1 to 20. This means with with 10,000 USD accounts, you can buy and sell almost 200 contract per trade. You can enter almost 200,000 per trade and open it multiple trade. This is all that is required to achieve exceptional high returns if you are using a bigger leverage. So that's all about leverage and trading. And there are people who use this leverage to, use it to gamble in the markets, because, you can put in $10 and decide to open so many positions, or put in $100 and open so many positions that is bigger than your accounts. Okay, so once the position go against you or retrace against you, it's wiped you out. Okay, so it is very important you understand how the leverage work and the margin work, so that you can use the money management procedure. Okay, now we are looking at having statistical edge over the market. Okay, so this is a disciplinary method of trading whereby you use a statistical edge because the market is highly volatile. You can have a strategy that wins. There's no strategy that wins 100%. So that's why some people are losing in the market and some people are making money in the market, and some people make money today, tomorrow they lose it. is because there is no statistical edge. They don't have statistical edge over the market. So how do you get a statistical edge over the market? That's what we're going to be discussing now. Okay, so for a professional trader, there's a statistic in the market from the data we've gotten so far that the most strategy have 45 to 60% winning rate. Okay, and then with that, if you have a risk to reward of 1 to 2 or more, if you use that, you can have what we call trading edge over the market. If you look at how the casinos guys play their game, okay, there is a saying in the casino that says the house always win. Why? Because they know that multiple people will trade. They already have an edge of about 5, I think it was 5 years over the traders that are playing, over the players. I mean, so if you look at trading that way, though trading is not gambling, but with your knowledge, you can be able to set yourself aside to have an edge over the markets. Okay, now there's a system that I've used. I've placed almost 100 trade on that system using the statistical edge methodology, and it has resulted to a consistent profit. So I decided to share it and also do research on some trader that talks about having statistical edge. It enables you to build a trading account as a business. So, I'm talking about building a trading account as a business. So that means you can trade and not look at a short outcome. You look at a long outcome of about 100 trade. Okay, so you look at a large sample of outcome, because in trading there are sometimes you might be experiencing losing strengths, and there are sometimes you'll be experiencing winning strengths. So that does not mean you should just jump up and start celebrating, or you should just regret that you lose money in the market. So you keep on, because you have a statistical edge, you have a strategy that works, you use this to your own advantage. So let's look at it this way. Statistical edge only work on a large sample of trade, which is about 100 trade. Okay, so in a small sample of 10 to 30, anything can happen. You can have a losing streak or a winning streak. Okay, now let's use this analogy. If you get a coin, okay, in a coin we have only two sides, the head and the tail, right? So if you flip it 100 times, okay, you flip the coin 100 times, what do you get? You're going to get probably 50 head and 50 tail, or 15 win or 50 lose. So it's kind of 50-50 chance. Now, but if you use what we call risk to reward of 1 to 2, okay, in which if you said, okay, you are picking the head, anytime the head comes up, okay, you win 2, and anytime the head the tail comes up, you lose 1. So in that, you have put the edge on that kind of game. You put yourself, you have 1, okay, you have edge over that kind of game, because it's going to be 50-50 outcome, but you know that once you win double, and when you lose 1 single. Okay, so if you do that consequently for about 100 trade, you are going to come out in profit. So now this is how the numbers work. So let's say 50 win, 50 loses. Okay, then we have 50. If you win 50 times, it's going to be 50 times 200. Let's say you are risking 1 to make 2, right? So if you risk $100, you are making $200. That's what the example here is signifying. So if you are risking $100, you are making $200. So anytime you win $200. Anytime you lose $100. So let's say you win 50 times and you lose, which is not in this form, because the winning rate of most traders is around 60. Okay, but let's even come to the middle, 50-50. Okay, so if you win 50, you lose 50. You have 50 times 200 for the winnings. Okay, and if you lose, you're going to be 50 times 100 for the losing. So we have 50 times 200, we have 10,000. Okay, and then we have 50 times 100, we have what? 5,000. So 10,000 plus minus 5,000, you're going to get plus 5,000. Okay, so at the end of 100 trade, you still come up as a profitable trader. Okay, you still come up, your trade still give you a profit of 5,000 because of what? Because you put the edge at your side. You use the risk reward of 1 to 2. That's why most traders will ask you to pick a setup that has a risk to reward of 1 to 2 or 1 to 1.5. It should be bigger. Don't risk the same amount. Okay, you are risking 1 to gain 2. Okay, so that's where the statistical edge comes into play. Okay, so and we're going to be looking at 4 kinds of traders. Okay, so there are traders who want to use the statistical edge, and there are traders who will like to use the okay, so we have 4 kinds of trader: the scalpers, swing traders, day traders, and position traders. Now, what are the characteristics of a trader that calls himself a scalper or is a scalper trader? Is looking at, you need to understand your methodology. You'll be exposed to a trading idea or knowledge. So you need to choose whether you want to be a scalper or you want to be a swing trader or you want to be a day trader or you want to be a position traders. We have different type of traders. So your result might not be the same thing depending on how the person is doing the market. There are people who want to enter the market quick. They want to enter quick and make short profit and go out. There are people who want to enter the market and stay long in the market. There are people who want to enter the market and stay longer. Okay, so a swing trader targets 5 to 10 pips. Are you getting me now? A swing trader targets 5 to 10 pips per trade. And his trade duration is within seconds and minutes. So if you enter within 5 seconds, 10 minutes or so, 1 minute, it goes out. Okay, just close. So the chart that most scalper they look at 1 minute to 5 minutes. So if you're a scalper, you don't have much business to do with the higher time frame. You look at the lower time frame. Okay, so higher time frame just give you the direction, but you come to lower time frame to pick your trade, and you watch your trade between some those minutes, and once you see a change of 5 to 10 pips, you go out, whether it's in your favor or not, because you're a scalper. Okay, so what is to be a scalper there, you need to understand the analysis also. You don't just because you say you want to check the time and you are trading a lower time frame, you don't know what the higher time frame is doing. So you must know what the higher time frame is doing, then you come to the lower time frame and then interpret it in such a way that you can make 5 to 10 pips. Now, the 5 to 10 pips, now you can decide to make it any amount. That's where we have a saying that says in trading, little mean much and much mean little. Okay, so if you're a scalper, it means you are looking for little, but you need to increase your lot size. Okay, so if you are looking for 5 to 10 pips, that means it does not mean that you are just making $5 to $10, depending on what you want your lot size to be. You can decide to say you want your lot size to be $10 per piece, or $20 per piece, or $100, depending on how much you have in your account. So let's, for example, your lot size is $10 per piece. That means if the market moves 5 pips, so it's going to be times 10. If you make $50, you close it. If you make 10 pips, it's going to be $100. But once you make $100, you close it. So you trade within a very short period of time and you go out of the market. Okay. Now for a day trader looks at the more higher time frame. So it looks at the 20 to 40 pips. Okay, a day trader looks at the 40 to 20 pips, and then if once the market moves 40 to 20 pips, it quickly close the trade. Okay, so a day trader watches the chart of 15 minutes, 1 hour, and 4 hours. Okay, day trader look at 15 minutes, 1 hour, and 4 hours. Those are great. So he's watching to get 20 to 50. So he increases his lot size. It doesn't have a business to do with 1 minute or 5 minutes because it's not a scalper. You're a day trader. So you need to know the strategy you want to use in the market. Then we'll have what we call the swing trader. The swing trader looks about, like I am a swing trader. Okay, if you look at my analysis, I pick my analysis from higher time frame. So I'm a swing trader. So if you look at my pips, you can see that I'm talking about 50 pips, 200 pips, or so it's a swing trader. I stay in a long in the market. So a swing trader look at higher time frame. okay, of 1 hour to 4 hours, even weekly or daily. But I execute my trade at 4 hours and 1 hour. So you target 50 to 150 pips per trade. And your duration of trade can be less than a week. I can stay for a trade for 2 days or 3 days, for even a week, depending on, because if I look at the higher time frame, I know the market. If you look at the Great Britain JPY that I gave the signal for, you can see that the market was dropping seriously, and we staying for that. We have about 3 entries on that market, okay, and one was running with almost 200 pips, one with 90 pips, with 150, and one was running with 9 pips. So you are moving, but as well we are trailing the market, okay. So a swing trader look at 50 to 150 pips. So you can decide to use any lot size, because now it has a chance of gaining more pips. That's when the little means big comes in, right? So because now the swing trader is looking at a very huge amount of pips, so he can decide to reduce his lot size so that it catches up with those pips. Okay, then we have the position trader. This is where most of the big boys are, the banks, okay, the cooperative. These are institutions that trade markets in a large quantities, okay, because the forex trader, we have people who trade, or players who trade in the market across bulk. Banks trade, some institutions trade, hedge funds, they trade the financial market, and the Wall Street guys, they trade the financial markets. No, these are the big boys that look about 500 to 100 pips. Now, what is their time frame? They look at the daily time frame and weekly time frame. So this is where they execute their trade. So you don't look at a particular trader and you don't know the kind of trader is, and you are following the trader blindly. So you look at what kind of trader. Is it a position trader? Is it a swing trader? Is it a day trader? So that you can know what time frame the trader is using, or depending on your own understanding of the market, do you feel it is good for you to be a swing trader or position trader? Okay, so you target for a position trader, it targets between 500 to 1,000 pips. Okay, between 500 to 1,000 pips. Now we're going to be looking at time frame and support, resistance, and the type of market analysis. Okay, so okay, so before we go into that, I don't know, maybe we have any other question. This is another session. We're going to stop. Then we'll move on to the other course that we'll be looking at. Then we'll look at okay, so I said we have, I'm going to share with all, for those who are just joining the market, maybe probably we have people who don't know much about Forex and they just want to learn. So I'm going to show you what NT4 stand for, okay, and what candlestick stand for, time frame, and what trend stand for, bullish and support, resistance level stand for. Then we'll now move into the type of market analysis, moving to the type of market analysis. So I'm going to quit this now. So if you have any question, you can drop your question. Do we have any question? Okay, Excel. Someone is asking what Excel do we have to put? Depending on the chart. Okay, so if you have a chart, you can if you have the setup, you can know where to put your stop loss or take profit. So do we have any other questions? Did anybody have questions from here? Okay, so no questions. Let me move to, let me share the chart. Okay, let me see. Okay, so let's quickly look at the metaphor. Let's quickly look at the metaphor. Let me share this. We cannot, this is a basic class, we cannot exhaust much in this class. So just look at the metaphor, so trading, there's a platform, okay? To do the trading business, there's a platform that you need to use. We call such a platform MetaTrader 4. We have the MetaTrader 4 or MetaTrader 5. Okay, for those who are joining, MetaTrader 4 or MetaTrader 5. So for you to be able to place trade on your account, you are going to open accounts with a broker. Okay, your broker will allow you to create an account. When you create an account, you verify your account, then you can open a trading account. So you can start with a demo account, okay? You don't need to put your money. You start with a demo account and practice, okay? Understand how the platform works, understand what is on the platform and what the Forex. It's not from afar, you look at it, but very clumsy. But when you come close and you get to read much about the Forex market, it is very, very easy to understand. So one of the things that will help you is to have a coach, okay, that can guide you daily or guide you anytime. So we have different resources on our Telegram group, Facebook, that I drop signals analysis that you can start from on your demo account before you go live. So one of the platforms, the software you need to install on your system is called MetaTrader 4. Okay, so you can see here, the MetaTrader 4 is here, is a FXC MetaTrader 4, and this is a demo account here I have here. Okay, so I just shared the platform, I believe you can see. So on this MetaTrader, there are different tools, okay, that you see here. Okay, so normally the chart comes like this with gray, okay, and you can decide to change the color of this candlestick or remove the gray yourself. Okay, so and change the color of this candlesticks. Now I decide to change the color to red and green. Now this red and green, each of this candlestick each of this thing you see here, Instagram you see here, is called candlestick. So the red candlestick means bearish candlestick, is a sell candlestick. It means the price is dropping. And then the green one is a buy candlestick. It means the price is going up. Okay, so this is the current price. This white line you are seeing here is the current price. It's trading, it's always moving. If you are connected to the internet, you'll see it moving. Okay, if you look at the number that we just discussed, let me go to a lower time frame. If you look at this now, you can see there's a number. This number is reading, is changing. Okay, so this last number, if you count 1, 2, 3, 4, the last number is called the pips. It's pips. Why the fourth number is called the pips? Why the last number is the pipettes? We call it. Okay, so you use it to calculate, okay, the move, the gain or the loss in the price movement. So this is the price movement. So there are some levels that you need to understand. You do analysis to know when the price is going to go up and when the price is going to go down. So we call it analysis. We have the technical analysis, the fundamental analysis, and trading sentiment or trader sentiment. So these candlesticks are formed in where we call the psychological level, which we call the support and resistance. So if the price, this white line, is above a certain price range, we call that place a support. Like this place now, this level, this is a low, this is another low. So when two low are hitting like that, this place become a support. Now, if you look at that one, if you look at where the price is going, I'll draw another horizontal line. So I'll go to the tools and pick my horizontal line. Okay, so we have different tools here to draw. So much of the work on your technical analysis is to draw, to find levels in the market. So if you find the level, you can decide to make a decision whether you're going to buy or you're going to sell. So let me pick this now. This place now, if you look at this place very well, this is a height, this is another height. Okay, now this is a height. So the price moved from here to here, it dropped, it moved from here, now it's going there. So this place become a resistance. So a resistance is a place where the market cannot be able to move, break upward, while a support is a place where the market cannot be able to break downward. It's respecting this level. We call such a level a support level. Why a level that the market cannot break upward, we call such a level a resistance level. Okay, so as this market, the market is moving, it's forming these candles. We call it candlestick. It's forming within a time frame. Now, if you look very well under these two, we have this 1 minute, 15 minutes, okay, 30 minutes, 1 hour, 4 hour, daily, weekly, monthly. These are the time frame we talked about. Okay, so each click, if I click on these now, this chart turns to 1 minute charts. So that means each minute, each minute, that's each 30 seconds, 60 seconds, these candles, a new candle will form. Look at that. This is a current candle forming right now. Okay, on this chart, you can see this thing is moving. Observe very well. You see this one is moving and it's green because the price is going. Immediately, if it's coming low, it's going to be red. Okay, now that tells us the difference between the red and the green. Okay, the difference is that the green, as you can see here, means that the market open here and closes here within that time frame. So the open price is below the close price, it becomes green. Okay, immediately the open price is above the close price, is going to be red. Like this one now, it opens here, this red one, it opens here and closes here. Okay, so this is the open price, this is the close price. It becomes a bearish candle. So the word bearish and bullish is being used. Okay, so this is a time frame and the market is moving high. Okay, it's going high. This is for 1 minute time frame. Now, if I change it to this, it's going to update. Okay, now it has changed to 5 minutes. So each candlesticks take 5 minutes to form. So if you go to 15 minutes, each candle takes 15 minutes to form. You go to 30 minutes, each candle. So the chart changes, but the same price, the same trading instrument we are dealing with here, this Euro USD, the same trading, but different time frames. So that's where we will now group trader to the scalpers. We group trader to the scalpers. We group them to the swing trade. We group them to the position traders because of the time frame they are looking at. So if you are looking at any time frame between 30 minutes, you are a scalper. You are scalping the market. So you are looking for a very short move. Okay, to quickly enter the market and go out. But if you are looking for a time frame, if you are looking at a time frame of 1 hour, okay, this is 1 hour and 4 hours. We are a swing traders, okay? You look at it very well and you see, okay, this is the price, the market has touched this price, it's going to pump up, and look at the market is pumping up. So if you get to this point, you can decide to say, this market is going to drop again, or if it breaks this level, it's going to buy again up to this level. Okay, so you need to be trained to be able to understand. If you don't understand the market, you need to be trained to understand how to identify this level on the chart so that you can make your decision on the chart. So that's about the bullish support and resistance, and then the ranging market. Okay. So now the trade, we have different type of trading strategy. Okay, now if you are trading just the candlestick and finding the level, we call it price action trader, which is one of the best strategy in the market currently. We have indicators traders, and we also have people who combine indicators and then price actions. Okay, we have those who combine indicators and then price actions. So you can now install indicators. Okay, so indicators also help you to know the level where to buy and where to sell, depending on how you understand the indicator. So most of the common indicators we use are the moving average. So if you click on insert on your chart, you will see move indicators. Then you go to the moving average, you go to trend, and then you see moving average. You click on moving average, this will come up. Okay, this parameter will come up. The recommended parameter that I use is 20, 50, and 200. Okay, 20, 150, and 200. So we're going to add 3 moving average indicators on the chart now. So let's say we add 20 moving average. You can decide to change it to whether exponential or linear, but most time I use exponential. Okay, so you change this to exponential. Then you can decide to change this color to any of the color that suits you. Let's leave it red because we're going to use then you can decide to change the distance to probably the width, okay, something bigger, or leave it like that. Okay, so you now click add. So this is a moving average. Okay, this is a moving average. Let me now break the moving average. Moving average tells you that once the candlesticks are forming below the moving average, it means that the price is selling, is going to sell, is in a selling mood. So you should be picking a sell. So when once it breaks it, look at the way it breaks it here, it's going up, it's going to buy, but later it comes and break it down. So when once you add your moving average and you see the price, the candlestick is still below, like this now, it's still below the moving average, although it's coming. This particular 1 hour, 4 hour candle just comes up. Okay, you see, it pushes a green, it's buy, you buy from here to here. Okay, so but still we have a sell pressure in this market because the moving average is still above the price. Okay, so the market still have a sell pressure. Okay, so you just need to look for the clinical entry, and that's what we do in our Forex champion analysis. We teach you how to look for the price action. So now, for you to be very sure, you add the second indicators. The second indicators, the moving average that we are talking about. So we're going to change this one now to 150. Okay, so these indicators tell you the strength of a trend, market trend. Okay, there's what we call trending in the market. The market is either trending up or trending down. Like from this chart now, the market is trending down. It's trending down. That means moving down. Is in a bearish trend. Okay, so but it got to a point which is a support level. You start retracing, it start going up, or you need to know how far the retracement will go. So you will use a moving average indicators to know how far the retracement will go so that you can make a move in the direction of the market. So we still leave this one as exponential. This one, so we just have to change the color. So let's change this color of this one to navy blue, and then we add. So if you look at it very well, you can see that yes, this one is higher, is a moving average, far away from the candlestick. So, but though it's still above the price, telling us that this is a trend. This is a trend. So for you to also be sure, because if you want to use a higher time frame, like I'm a swing trader, if I go to higher time frame, this one will have more effect. Look at daily trade. So you can see there's a crossing, and all of these are under the move of the market. So if you go to it, you can see that it's different from here. Okay. So it's just a guide. The moving average is a guide to tell you whether a market is trending or not. So you can decide to add the third one, the third indicators. So moving average, sometimes I use 3 moving average. So let's use 200 moving average just to tell you. The 200 moving average is to tell you where the big boys, because they are the ones bringing in the volume into the market, to tell you where they are pushing the market into. Okay, so if you understand the indicator very well, you will know where the banks are trading. So you can use another color, let's say yellow, for the 200 moving average. You put it there, you can see now. You see that the 200 and 150 are moving simultaneously, telling you that the pressure, the big boys are selling this market, though from a daily time frame, there was a cross, okay, and the market is still below until it gets to touch this plate and change, before we can now know that the big boys have changed their mind that the market is going to be buy. But so far, all these 2 moving average are below. It means that we still have a bearish movement. But you don't just sell. You need to come to a lower time and find a clinical entry. Now, I remember I told you that your work as a trader is to buy low and sell high. So from this chart now, from this region, and this is a high point, this is another high point. No, so this is a high point and this is a low point. Are you getting me? So you are going to sell here and buy here. So if you want to sell, you wait for the market to touch this level and form some certain candlestick pattern before you sell. So you can decide to sell. So let me see. You can decide to. I want to draw something. Okay, yes. So once the market form a bearish setup, there's what we call setup. You can sell from here and get your target in this place. Are you getting me? Your target is going to be here. Then someone was asking, where should you put your stop loss? Now your stop loss is going to be somewhere around this place. Okay, so that you give the market room, or you put your stop loss around here. Okay, so you calculate what's your stop loss, you put your stop loss there, and then you put your stop loss, let me see. So you put your stop loss above, let's say you put your stop loss. So your stop loss is going to be 1.17. So this is when you see a sell setup though. So there's no sell setup yet. But if you see a setup, just like what happened here, see there's a reversal candle, then the market drops. So if you see another reversal candle here, you put your sell here, you target this place. Are you getting me? So you put your stop loss here. So if you look at now, risk to reward is going to be more than 1 to 2. So when the market hits this place, you make more profit. Then if it goes and go against you, you just lose small capital, a small amount of money. So depending on what you are putting as stakes, that's under money management. We can't discuss much on this because this is a basic class. It's just to put you to get a startup for what Forex Market is all about. So, okay, so now if you have that, then there's another indicators that it will help you. Okay, for those who are at least amateur, is to get this indicator. We call it a oscillator because market oscillates. So you need to know when the market has overbought and oversold. So the oscillator I use is stochastic oscillator. Okay, so if you put this oscillator, you see that the market has just, this place was oversold. This is overbought. This is overbought region. So you wait for the line to cut in so that you sell. Okay, so these are technical analysis. So it's your first time, it's going to look clumsy, but you need to come for the professional class so that you understand better. I can't express some dynamics on this. I just talked about the technical analysis. Now there are other analysis that also you need to look at, the fundamental analysis. Fundamental analysis has to do with the socio-political happening of the country or the currency you want to trade. So there are websites that give you this news that tells you about what is happening in US, what is happening in UK, unemployment rate, that is micro economical factors, the unemployment rates, the NLP, that's non-farm payroll, the interest rates, the IP, that is index price index, all this affects the market. So that's based on the fundamental. Then trader sentiments, there's some website also that you need to go to know what traders are doing so that you know if they are buying or selling. Okay, so pretty cool. We're going to stop this here for technical analysis. Then for you to install, we also have a mobile app for the mental trader. So if you install the mobile app trader for your phone, you can decide to log in your account and then you trade. Okay, so quickly let me move on to for you to be a professional trader. Okay, you need to, this is just an introduction. You need to understand this course. We run a professional course. We run a professional trading academy. So on professional trading academy, you are going to learn in details what the Forex market is all about. So let me brush through what you will learn if you apply for the professional trading course that I'm going to be teaching. So let me see if I can go back to this. Okay, so this is it. So the Forex Champions Academy course, this is a course we're going to take you through. Okay, so that market is not a one-day store. You need to understand the market very well. So this is what you're going to learn. Okay, you apply to be trained by us. You need to do the number one, introduction to Forex, which is the business of Forex trading, which is what we did now. We just did course 1 now. How to profit from a move, we just did that. And the secrets of consistent profit, the statistical edge, trading like casino, we just did that now. and the mastering technical analysis, which you need to go into. The principle of technical analysis, candlestick pattern, identifying trend, utilizing support and resistance and supply and demand zone, mastering moving averages, okay, and using MT4 charting patterns. So we can't discuss that in this class. This is for basic class. So if you come to the professional class, you learn all this position sizing.
It's continued lesson 4, lesson 4, 5, and 6. We're going to be looking. Lesson 4 is position sizing, how to understand the position size, how to manage your funds, position sizing and money management. For professional trader is a professional business. So you need to understand all this. It's not about knowing when to enter the market and you just enter the market unprofessionally, right? So you need to understand how to trade this professionally, how to automate your system. Lesson 5, FX impulse pullback and strategy. Okay, pullback strategy. The strategy we use the pullback price action pattern, entry and exit rule for impulse pullback, long and short setup, filtering for high, how to filter for high quality setups, trade management and exit strategy. Lesson number 6, psychology of winning trade. So looking at how to win a trade, how winning traders think, managing and overcoming negative emotions, how to manage temporary drawdown, because in forex trading there will always be drawdown. Okay, so your mind to become a winning
trader. Okay, so we'll be looking at those curriculum as you see. The 7 is a course, so you don't learn forex in a day. So the only advantage is you get is that if you have a mentor, it can squeeze those things to a shorter period of time. So we'll also be looking at FX impulse pin bar strategy. Okay, how to identify where the market is going to change, the bullish and bearish pin bar. Okay, impulse pin bar price action patterns. We're going to be looking at that. Entry and exit rule for impulse and pullback, long and short setups. Filtering for high quality setups. We're going to be looking at that, and trade management and exit strategy. Okay. So we will now leave you to develop your own FX plan. Okay, trading plan. You develop your own winning strategy. And also for those who want to trade as a business, maybe you have a work, you don't have time to trade. I trade every day. This is what I do. So I can decide to stay in front of the computer for long, but that does not mean that's what it entails to be a trader. So you can decide to choose whether to spend 3 or 6 hours or to spend 1 hour and automate your system. So we'll put you through on how to do that, how to keep a trading journals. Okay. Choosing an FX brokers. We have very fantastic broker that we're going to be introducing to you. And one of the broker we're looking at is the FXCE. So we'll just touch a little bit about FXCE because of the contest that is coming up. Okay. So this is where the Forex class will end. I don't think we're going to go into the other aspects. Okay. So I will stop the sharing here. If you have any questions, just let me know before we go into. Do anybody have any question here? Do you have a question?
Yeah.
Okay, so what's your question? Who has a question or have a question? Okay, so okay, just before we round up and end the class, I think we spent close to 2 hours already. So before we before we round up and end the class, if you don't have a question, we'll just introduce this broker to you, the FXCE as a broker or a platforms that allow you to be able to understand risk management in trading. A lot of people have unpleasant knowledge about the Forex market because they've lost a lot. So, okay, I should explain. Someone said I should explain moving average. Okay, we're going to do that. What broker is advisable? Okay, we for now you can contact me. For now we are using Deriv as my main broker, Deriv, and FX. I recommend you should use more than two. You can use Deriv. Okay, then we have the FXCE here, and also we have the FXT. That's Forex time. Okay, I'm going to go back to the moving average again. I should explain moving average again. Okay. Okay, so before I go into that, let's look at okay, let me just I'll create time for those who are joining from the Facebook group that you want to partake in the FXC Forex Champions FXC contest. Okay, so that's we'll look at trader's guide, how to use a trader guide, and also the rules. It's very, very important. So we're going to create a different training session for that. But just if you're interested in trading contests as using demo accounts, you're not paying any amount of money, you are not funding your account, just let me know so that I will give you details on how to go about creating a demo account so that you'll be notified on the 30th of this month for the contest. Okay, so there's a fantastic website that also allows you to trade with money management using trader guides. You can be able to put your risk management in place. Okay, so let me just stop it, and we'll go back to the other person that's asking. Okay, so we go back to moving average. Someone said I should explain moving average again. Okay, so let me just share them. Okay, so moving average, as I said, okay, you can use one or two, but probably you should use three moving average, especially if you're a swing trader. Okay, you want to look at higher time frame, what the higher time frame is doing, and you come down to the lower time frame, and you know how to make the decision in the market. So, moving average is a trend indicator. It follows the trend, and in Forex, the trend is your friend. So you want to know which particular trend you are dealing with. Okay, we have three types of trend. Actually, we have a strong trend, we have a healthy trend, and we have a weak trend. Okay, so the three moving averages that I use shows you when a trend is a strong trend, and it tells you when a trend is a weak, is a strong, but it's not healthy, it's just a strong trend. It's a strong and healthy trend. I mean, it's a strong and healthy trend, and we have a strong trend. Then we have a weak trend. So a strong and healthy trend respects the 20 moving average consistently. So whenever the moving average is above above the price and the price is below, it means that the trend is a bearish trend and is a strong and healthy trend. Okay, so once the price is not respecting it much and it's respecting the 150 moving average, it tells you that it's a strong trend, but it's not a healthy strong trend. Okay, so once it violates the 150 and is violate the 200 moving average, it means it's a weak trend. It's a bearish trend, but a weak bearish trend or a weak bullish trend. So moving average tells you where the market, the trend of the market. Okay, so we've applied, I believe you understand, we apply the 20 moving average, the 150 and the 200. So for this chart now, which we are looking at, the Euro USD, okay, this is a live account, live market. Okay, so the market is moving currently. So if you can look from early hour of today, okay, the market, it was respecting the 120 moving average just now that it hit the support level and now it has violated it, but it's still a bearish trend. Why? Because it has not violated it has not violated the 150 moving average, and it has also not violated the 200 moving average. Okay, so moving average actually tells you where the market is going. It also tells you if you are using a big moving average of 200 and 150, it also tells you the direction boys have picked. That's the big boys we are talking about here now at the banks. The direction where the banks.
The compounding effect. Now, hole number one, your 10 cents is going to be your number one, you still have your 10 cents. Number two is going to be 20 cents. Okay. Or number three, you have 40 to double to 40 cents. Or number four is going to be 80 cents. Or number five is going to be.
We're done with that. Sorry for that. Okay, so we are looking at okay. So the moving average. So the moving average tells you where the market. So if you are using a higher moving average of 200 and 150, are you getting me? You need to go to the higher time frame to know where the big boys are trading. So if you look at this now, okay, this is weekly. Okay, so on a weekly, the market actually violated the 20 moving average. So we know we are dealing with, if you go to a lower time, we are dealing with a bearish trend. That means the market is a bearish. So once we are dealing with a bearish trend, it means that you should be picking signals or entry in the direction of the bearish trend. Are you getting me? Okay, so but because the market is coming close to this higher moving average here, if you look at that, it tells you that the market, the bearish trend might get exhausted here. Okay, so if you're a smart trader, you will know that the big boys might make a change in this place. They can change their mind. Okay, so you go to a lower time frame to know again. You see, if you go to a lower time, you see that the moving average is everything. All the moving average are above the price. So we are dealing with a bearish movement, but it's just that we are very close to a support level. Are you getting me? So you move down again. So you need to, this is what we call top-down analysis. It requires a lot of practice and all of that to be able to understand. So if you look at this now, you see that the price is moving into the moving average. You can move and come into the moving average and then decide to, because it's a retouch, and decide to start selling. Are you getting me? So you can decide to start. So, but you need to first of all know that this is also a resistance level, which we drew that time. But you draw a resistance level and you'll be watching out for a sell. So once the sell did not come from here, you should know that the market is pulling back into this moving average. Okay, so once you pull back into there's high chance, just like we have something here, there's high chance that the market is going to drop again. Okay, so it dropped to this level. If it is not holding, it might just drop again. Okay, so what gives me this understanding is the moving average. Okay, so a weaker moving average can be broken, got into a stronger moving average, which will hold the retracements. There's a retracement currently going on right now on there's a retracement going on. So you can see, if you come to a lower time, you can see, so the market now has violated this moving average here. So it's pushing to enter the higher moving average, which the higher moving average they've been acting as a resistance. So it has acted as a resistance here. There's a chance that it will act as a resistance here. That's if when this particular level is being broken. Okay, but there's a place. Okay, let's look at it here. Okay, so that's the ranging I used the other time. So once it broke, if it broke this level, fine. If it didn't break it, the market is going to go and touch the moving average and start selling. So the moving average is giving a guide. Okay, so it tells you that the market is trending. But once the market is far away from the moving average, there's what we call pullback. That's why you need to go through all those courses to understand. The market will pull back into the moving average before it will either break it or continue the direction which it has previously said is going. Are you getting me? So you need to understand, for you to be able to understand moving average in details, you need to apply for the course, professional trading course, so that you get it. That's all. Do we have any other questions? Yeah, do we have any question? Okay. Okay, so if you don't have any other question, and we have done justice to this basic trading. So the only thing you need to do next is follow up. You can't learn everything on this first class. It's basic. So giving introduction, how to trade as a business. Okay, how to build a forex trading account or mindset as a business. I've introduced you to moving average, three indicators, moving average, and oscillators, and also when to buy and contract. This is the basic knowledge that you need. Then for you to be able to trade professionally, you need to be trained. Then you will now know which accounts you need to put. Okay, so thank you very much. I believe, okay. Someone is, let me pick one or two questions here. Someone is asking, sorry, is it advisable to be using Martingale while trading for it? That is if I execute a trade with 0.1 loss side and trade. Oh, this is a system, but it's very risky. If you know how to do it, you need to practice this on your demo accounts. Okay, the Martingale strategy, whereby you pyramid trade. Okay, you need to practice it very well. There are people who build robots on that, but it's not sustainable. Okay, so the major thing, just understand the market, pick your trade. You can take advantage of your setup, right? Just like what I'm doing. If you know that your analysis is right and you pick the trade, you can decide to be able to add more trade to your position. And that's if you are there to watch it. Okay, but if you are not there to watch it, don't add to your position. But if you are there to watch it and you know what's going on, you can add to your position. So I think those are the two questions. Okay, so if you have any other question, you can drop on our Telegram group. So by that, I will call it a day. Thank you very much, everyone, for joining, and spread the message. Follow me on my Telegram group, Ostinates. Then I'll add you to the Forex Champions group. Also on YouTube, please. Follow us on YouTube, Austin J. Agabi. You'll see me. Follow me on YouTube, and also like the channel so that we can grow and put more. I give analysis, live analysis, so you can use that to build yourself also. And also follow our Facebook group, FX price action setups, and will be good to remain in this adventure of trading. So if you don't have any questions, I will call it a day. Thank you very much, everyone. Bye for now. Bye for now, everybody.
Okay, thank you. Bye.
Okay, so bye. So bye for now. You can say something. So we don't have question. You can say something. Bye for now, everyone. Thank you, Tunde. Thank you, Akuro Ode.
Good one.
Thank you, Temidayo. Thank you. I can't really pronounce this name. Hongon, or is the guy from FXCE. So we will do, I think I'll schedule another class so that you can actually come on board and explain most of the opportunities FCE. Okay? Bye-bye. Thank you, everyone.